Kevin Prendergast, Director of Wealth Management at the Retirement Network, Wheelan Smith. I'm recording this video on Friday, October 21st. We're going to get into the September 2022 segment rates recently published by the IRS earlier this week. For some of you, not all of you, for some of you, this will be the last video that we publish and distribute before you make the big decision about your retirement date and your pension commencement prior to year end. The reason I say some of you, important to remember, there are numerous AT&T pension programs. While the programs are similar, there are some subtle but important differences with respect to the timing of commencement. So just bear that in mind. That's why I say some, not all. Okay. So first things first, the interest rate dynamic is really significant. It's really impactful. And interest rates have moved meaningfully higher this year in a way that we haven't seen in a long, long time, decades. So we understand there's lots of conversations occurring in the hallway, so to speak, whatever the 2022 version of the hallway is. And so there can be a lot of misconceptions, a lot of rumors, et cetera. So what I want to start with in this video is talking about some of the things we're hearing that are not quite correct and that can lead to some confusion. The first thing, and perhaps the most important dynamic, is that these segment rates impact pension lump sums only. If you've thought long and hard about your situation and you have a strong preference for the monthly annuity, then these segment rates are not important to you. It's only if you have a preference for the lump sum that you care about these segment rates and the direction of these segment rates. Okay, so first things first, segment rates only impact pension lump sums. They do not impact monthly annuities taken directly from the pension. So moving on to misconception number 2, that last comment, directly from the pension. Sometimes when you meet with a financial representative, they will recommend an annuity product to you, an annuity product sold by an insurance company. That is a very different transaction than a monthly annuity taken directly from the pension. In order to buy an annuity from an insurance company, which candidly is a transaction we have mixed feelings about, you first have to take the lump sum from the pension, which is impacted by interest rates, and then you take that lump sum and you hand it over to the insurance company. So it's a very different transaction. Even though the word annuity is common, it's a very different transaction. Okay. Number 3, these segment rates that I'm about to put on the screen, they change every single month. Therefore, the impact of these segment rates is not permanent. The rates to be published for November of 2022, which won't be published until December, right? We're always looking a month behind us in the rearview mirror. Those rates will impact pension lump sums commenced in 2023. So the November 22 rates will impact pension lump sums commenced in 2023. We'll be doing this exercise again next year, again the year after that, again the year after that, et cetera. So if after considering your personal circumstances, you decide to remain with the company beyond this year, that's okay. We're just rooting for interest rates to come back down in the years ahead, right? If you're 10 years away from retiring from AT&T, a lot can happen in 10 years. Okay, so this year over year change, it impacts pension lump sums commenced in 2023. But if you're retiring from AT&T in 2030, this topic isn't worth wasting a whole lot of time thinking about, okay? Because interest rates can and will change quite a bit between now and 2030, okay? With all that said, let's get into the latest and greatest interest rates. And as always, start by showing you our homepage, theretirementnetwork.com. If you're unsure, if you're ready to retire, or if you're unsure about taking your pension as a lump sum versus a monthly annuity, click on the Get Your Free Assessment button. Schedule a conversation with one of our advisors. All right. Let's look at the September of 22 rates, compare them to the November of 21 rates. You will see we're back on an uptrend in a major way. So our November 21 first segment rate is all the way down here at 1.02%. As of September, we're all the way up at 4.48. Second segment, we've gone from 2.72 all the way up to 5.26. And in the third segment, we've gone from 3.1 all the way up to 5.07. So we've now punched through the 5 handle we're talking about a 20 to 25% impact for modified rule of 75 eligible pension lump sums. Okay, so it's a major impact. It's probably a six-figure amount for many of you, so it's worth considering very, very carefully. Again, the decision to retire is a significant decision, involves factors that extend well beyond this pension lump sum, but this is a big enough move that if you're within a couple of years of retirement, it should definitely have your attention. Okay, so if you're someone who chooses to stay with the company, last comment, beyond this year, and you're looking for some guidance on where interest rates may go in the future, this is kind of the market's best guess. Doesn't mean it's right, but this is the Treasury yield curve. And if we look out in 2, 3, 5, 7 years, you can see that the market is predicting rates will come back down from where we are today, but not all the way back down to those November of 21 levels. Okay, so that's kind of what the market is predicting. This is the treasury.gov website, where Treasury interest rates, these are not the rates used in your pension lump sums, by the way, they're just kind of a barometer that we reference, a point of reference. Market is predicting that rates will come back down in the years ahead, but not all the way back down to the November of 21 levels. Okay, hopefully this is helpful. See you next month. Take care. Bye.